Good afternoon, everyone. Welcome to the launch of the 2018 Regional Economic Outlook for Sub-Saharan Africa, October 2018 edition. My name is Ismail Adjei. I am from the Communication Department of the IMF. So it's my pleasure to introduce our two panelists to you today. To my right, to my left, Abebe Ambrose Selassie, Director of the African Department, and to his left, the Senator Udoma Udo, Minister of Budget and National Planning for the Federal Republic of Nigeria. In terms of the process, Abe will start with a presentation of the economic outlook, followed by remarks by the Minister. After that, we'll open it up to questions, and then we will close. So without further ado, I'll hand over to Abe for his presentation.
Thank you, Ismail. A very good afternoon to you all, and thank you for joining us for the launch of the Regional Economic Outlook. And I would like to thank Senator Udoma for agreeing to be a panelist and critic on this presentation. I hope you will not agree with me too much and will provide your views. This afternoon, I would like to present our Regional Economic Outlook, which we've entitled Recovery and Rising Risks. My presentation basically will have three main parts. I will try and show a couple of slides on the external environment facing sub-Saharan African countries at this juncture. I will then go to look at, discuss a little bit, somewhat briefly, the outlook and risks that the region is facing, and then talk some about the policy challenges we see facing policymakers at the moment. By now, I'm sure you will all have seen or had a chance to internalize the growth forecast for the global economy that we've shown, which showed the growth globally having plateaued, but still, plateaued at around 3.7%, which overall is supportive, more supportive than has been in the recent past. So on the growth front, the conditions are as supportive as they've been in the last couple of years. However, some aspects of the external environment have become more difficult, facing the region have become more difficult. Most notably, financing conditions facing the region have tightened quite perceptibly since April. The chart here on the left shows the change in the region's frontier markets borrowing costs since mid-April, and compares it to two recent episodes, two recent bouts of global volatility that we've seen in financial markets. Specifically in 2013, what was called the taper tantrum, which is shown with the dashed blue lines. And then, of course, from August 2015, we had an episode around the stock and oil price market declines, which is depicted here in the gray line. Basically, what we've seen so far in terms of borrowing costs for the region is that costs have gone up quite in a pronounced way, as shown by the orange line, which is the most recent data. They're not yet quite as bad as what we saw in the wake of the commodity price decline, but certainly in terms of performance up to now, the rising cost has been quite pronounced, of the order of 150, and in some cases 200 basis points increase in borrowing costs. The chart on the right shows, basically shows what has happened to portfolio flows to the region in a cumulative way. And what we see there, though, is that the episode so far has seen a similar level of outflows as we saw in the last two episodes. So a very difficult environment relative to what countries were facing, just around April of this year. A second aspect of the global environment that has changed relative to our last outlook in April has, of course, been the continued increase in commodity prices, particularly in the case of oil. which will be beneficial to oil exporting countries. But as always, oil price increase and other hard commodity increase is a double-edged sword for sub-Saharan Africa. So this increase in oil and natural gas prices will be beneficial to the 8 oil exporting countries, but will have, of course, an adverse effect on much the rest of the region. So again, on commodity price, a very mixed picture, one which will be beneficial to oil exporters, but with an adverse effect on much the rest of the region. So this is the external outlook. This is a change in the external environment. What bearing is this having on growth? Our projections are now for the region as a whole, growth to increase from 2.7% in 2017 to 3.1% this year, accelerating to 3.8% in 2019 for the region as a whole. This path is depicted by the orange lines that you see on the charts behind me. But as you can see, and as we've seen in recent years, there's quite a lot of heterogeneity in the growth path for the region. Growth remains fairly anemic in the oil exporters, the 8 countries as shown here by the blue line. For other resource-intensive countries, that's countries like Sierra Leone, Liberia, significant metals exporters, Zambia, and the like, growth has been of the order of 3–4%, and we see it continuing at that level. But I do want to stress that, weak as the aggregate numbers are, we see quite a lot of countries, around 22 countries, which have continued to sustain growth at the 5–6% mark. So a fairly heterogeneous picture when it comes to growth. And over the medium term, what we're seeing is growth, at least on current policies, plateauing at around 4%. This, of course, is still too low in per capita terms from what is needed to make a significant improvement in living standards. So just to drill a little bit into the projections in 2017 versus 2018, there is somewhat of a positive story here where the reason why growth is being marked up relative to last year is because of improvement in growth outcomes in the oil exporting countries. In much the rest of the region, though, growth remains more or less the same level as has been in 2017. What this chart shows is basically a lot of clustering around the 45-degree line, except the blue dots, which depict the oil exporting countries. And in those cases, growth is north of the 45-degree line, which shows the recovery that we're seeing in oil exporters. Now, playing off what I said a little bit earlier, one thing we feel that has to be watched very carefully in terms of the risks facing the region is the global financial conditions and what it might do to the financing picture for countries. In the first half of this year, as you can see on the left chart, the region's frontier markets issued bonds at record levels. About $14 billion worth of borrowing was tapped. The markets were tapped to the tune of about $14 billion, higher than any year we've seen previously. And this $14 billion compares with $7.6 billion raised for the whole of 2017. One concern we have going forward is that with financial markets having tightened and going forward, quite a strong possibility that rates will go up. The same level of access to financing access will not be available for the regions going forward, for the region's countries going forward. Now, in terms of amortization that's falling due over the next several years, this is generally looks manageable. That's the chart on the right with the orange bars. It's not so much rollover risk that we're worried about, but the access to financing to the same extent that has been available in recent years not being maintained. We see this as a strong risk with attendant consequences, of course, for countries' capacity to pursue more expansionary fiscal policy. One other point I would like to stress is that, often when we look at projections, we tend to look at risks in isolation. But the possibility that you have a combination of these individual risks materializing is non-trivial. Most notably, countries could face a combination of higher oil prices, weaker currencies as a result of the pressures we've been in currencies in recent weeks, and higher spreads. So the combination of all three could be quite a pronounced shock to many countries in the region, and this is something that has to be guarded on and monitored as policies are being formulated. So, what are the policy challenges at this juncture? I would like to focus on three challenges that we see, that are emerging as priorities for countries. The first one revolves around addressing debt vulnerabilities, which, as we've noted in recent years, have been increasing. Most notably, the level of public debt in sub-Saharan Africa has gone up by about 20 percentage points and is now at around 57% of GDP. This 20 percentage point increase has happened over the last 5 years. Of course, at this current level, the debt to GDP ratio, for the region as a whole remains well below what it was in the mid-2000s. However, what is concerning us is that the current lower level of debt still has higher interest burden attached to it. So in terms of the level of debt servicing, the level of interest payments on this debt, it has crept up to close to the levels that we were seeing in the 2000s with much higher levels of debt. So on the debt servicing side, we are seeing quite a pronounced pressure, as the chart on the right shows. About 10% of interest payment is now going towards servicing debt, which of course means that there is some diversion of resources from investment in infrastructure, investment in health, education, and other priorities for governments. So this is one concern that we have. At the same time, these averages mask quite a lot of heterogeneity in debt circumstances in the region, and this is a point I want to stress strongly. Most notably, the number of countries in actual debt distress is 7 at the moment, and this is concentrated in countries that are either very fragile economically, politically, or countries that have been hit by the decline in commodity prices. An example of the countries that are now in debt distress as a result of decline in commodity prices, of course, are Republic of Congo and South Sudan. And there is a concentration in countries that are very fragile or oil exporters in countries in actual debt distress. That said, we do now have around 8 countries that are at the high risk of debt distress. These countries will need to ensure in implementing fiscal consolidation, in particular improving domestic revenue mobilization, to be able to avoid going into debt distress going forward. So they are on, they are countries where the red light is flashing. And of course, for much the rest of the region, debt remains at the either moderate risk or low risk category and remains manageable. So a heterogeneous picture in terms of the debt circumstances in the region, but one that has to be watched in an increasing number of cases. Again, elaborating a little bit further on this heterogeneity that we're observing in the debt vulnerability and the debt circumstances in the region. This chart breaks down the path of fiscal balances and debt for three analytical groupings that we've been using in the last few years. That's the oil exporters, other resource-intensive countries, and the countries with more diversified export bases. What we see here is that in the case of the oil exporters, which is shown here by the blue line, what we've seen essentially is a very big increase in debt, which is shown by the movement along the horizontal axis in the wake of the decline in commodity prices and the hit that caused economies. But more recently, some decline in debt levels as economies have recovered. So you see this very strong movement in the debt path for those countries, and in particular a swing into fiscal surplus for the region's oil exporters as a whole. One concern, though, is that in the other countries, the countries which have been sustaining growth, what you see is the debt path. The path for the chart shows basically for both the gray line and the orange line. Debt levels have continued to increase, and this is exactly in those countries where growth has been relatively robust. So one concern we have is the continued pro-cyclicality of policies. So despite reasonable and high growth in many cases, debt levels have continued to go up, although in the case of the diversified exporters, it has tended to stabilize, albeit at the level of around 60% for the group as a whole. Now, I do want to note that countries haven't stood still in the wake, in the wake of the decline in commodity prices, and have done quite a bit to try and address the fiscal hit to their account that they faced since over the last 3-4 years. So there's been fairly significant adjustment, particularly in the oil exporting countries, fiscal adjustment of the order of 10%, as shown on the bar on the left side. The adjustment, however, has been very much in terms of compressing spending, particularly capital spending, rather than more durable adjustment by way of mobilizing more tax revenues. So one concern we have is, welcome as the adjustment has been, the nature of adjustment needs to improve going forward to be able to be, good quality fiscal adjustment, one that is more supportive of growth in particular. The second policy challenge that we see revolves around managing capital inflows. There's two reasons we focused on this issue in one of the analytical chapters in our Regional Economic Outlook this time round. One, of course, is the fact that we've noticed that over the last 5-6 years, deeper integration of sub-Saharan African countries into global capital markets, as I will show in a moment. And the second one, of course, is the current conjuncture where we're seeing quite a lot of volatility in international financial markets, and with the tightening cycle in the United States in particular, quite significant risk of borrowing costs going up in the region. So this is a very interesting chart that comes out of this second, one of the analytical chapters in the Rio, and it shows how much sub-Saharan Africa has integrated into the rest of the world financially. The level of net capital flows in the 1980s and 1990s stood at the order of around $4 billion per year. By 2017, net capital flows to sub-Saharan Africa had gone up to $60 billion. This is a massive increase in the volume of non-official capital flows. Let me be very precise. We're talking about here, capital flows which are of a private nature, driven by investment, not driven by official action. And this is a very significant increase. And the region's integration into global financial markets has accelerated, particularly in the wake of the global financial crisis. as the bars show here a significant pronouncement in the movement of flows. The blue bars depict basically the capital liability flows, debt creating flows to the region, and the asset flows out of the region are shown by the orange bars. But the net flows, as I noted, are positive, strong, and have been increasing over time. The direction of these non-official flows, of course, contrasts with the general declining trade and official development assistance to the region. Moreover, if you actually look at some periods in recent years, what we see is flows to sub-Saharan Africa have been bigger than that to other emerging market economies. What we did was to scale the flows that we showed earlier by GDP to be able to compare them with other parts of the world, and broke them down into different episodes. And what we see here is basically, for example, in the 2015 to 17 period, as depicted by the fact that the blue bar, which shows sub-Saharan Africa being way larger than the orange bar, which shows the emerging market economies, the amount of inflows to the region was almost double what emerging market countries were experiencing. What the work my colleagues did show is that the factors that explain this significant increase in flows are both external as well as, of course, domestic factors. On the external side, there's been quite a lot of impact from the low U.S. interest rate environment. Global risk aversion, we find, tends to affect the volume of flows, and commodity prices also drive the volume of flows. And on the domestic front, we see generally a strong correlation between strong macroeconomic fundamentals, high growth, openness to trade, facilitating capital flows to countries in the region. By the same token, what we found was also that we looked at what we are increasingly seeing in the region is a strong impact from movements of capital into and out of the region on investment and growth outcomes. Portfolio flows have historically not been strongly associated with domestic investment, but this relationship seems to have changed in recent years. And what we're seeing is a strong correlation between portfolio flows and domestic investment in recent years. However, portfolio flows also seem to be facilitating a boost in public consumption. We appreciate some of this is going to, of course, social spending, but also is facilitating broader government consumption that may not be of the right investment. The second topic that I want to touch on in terms of the policy agenda, priority on the policy agenda, of course, is what to do to raise the growth rates in the region. As I noted earlier, what we see is at the moment on current policies is an environment where, for the region as a whole, we will have about 1.5% per capita growth through the early 2000s, through the early 2020s, and this really is way too low, and not much more, in some instances, lower than what we're seeing in developing Asia, for example, and on a par on what we're going to be expecting to see in Latin America and the Middle East. And given the catch-up possibilities that sub-Saharan African countries have, the strong potential that many of our countries have, raising growth is of really very strong importance. Now, to be fair, these averages mask the fact that we are expecting to see a number of countries continuing to register strong growth. So the likes of Ethiopia, Cote d'Ivoire, Senegal are projected to grow at 6-7%, and that will be, so there are countries that are where the growth outcomes is expected to be high. But for the region as a whole, growth remains low, and policies are needed to boost growth. I don't, you know, sorry, we have a glitch. Okay. Of course, I don't want to belabor the point too much, but particularly for this crowd, but growth is, you know, higher growth is going to be, of course, of particular importance to allow countries to make progress towards sustainable development goals. The region, as you know, has made very important strides in improving social outcomes. In recent years, we've seen very strong improvements between 2000 and 2014 in primary school enrollment ratio, which has risen from an average of about 60% to 80% in the region as a whole. Secondary school enrollment levels have also increased, albeit a lower amount in recent years. But there remains quite a lot of heterogeneity in these outcomes. This chart here shows on the left the dispersion of the average improvement in primary school outcomes. On the right, secondary school enrollment rates, and the dispersion around this average level. And with the growth momentum for the region as a whole stalled or remaining at the current level, we think there is, you know, the risk that the SDGs will not be met by 2030 is high. So much higher growth coupled with strong external financing is going to be necessary to facilitate the SDGs achievement. And on our country's front, of course, you know, on policymakers' front, raising this growth is going to be the priority. The second factor, you know, that is important for getting growth up. Again, for the policymakers in this room, it doesn't need belaboring, but you know, the number of new job entrants into the labor force in sub-Saharan Africa is going to be close to between, you know, 17 to 20 million per year in the not too distant future. Given this demographic dynamics, you know, higher growth is going to be essential, sine qua non, to be able to create the millions of jobs that we need to be able to generate for all of the young people coming into the labor market. In recent years, the number of jobs that have been created in the region has only been of the order of 10 million. So there's a need to basically almost double the number of jobs that our economies are creating in the coming years. And this, you know, I want to touch on and cede the floor to Minister Udoma by advertising the second analytical chapter that we've produced accompanying this regional economic outlook. This chapter focuses on one aspect, you know, the unfolding fourth industrial revolution and what impact that is going to have on sub-Saharan Africa's challenge to foster job creation. You know, the chapter is, the document will be available, so you can, you know, look at this in extensive detail, the analysis that we've done. But one of the things that we find is the unfolding industrial revolution will pose, you know, creates both opportunities for the region, but also poses some significant challenges. Our analysis shows that, you know, historically, technology and labor have been complements. So you can think about all of the technology that has, you know, since time immemorial, that has been invented, and that, you know, without greatly impacting labor force participation rates, at least at the global level, even though there has been some impact in the distribution of labor force participation over time. So in general, historically, there is some positive things to look forward to in the unfolding industrial revolution, which is that subject to technology not displacing labor, we think it offers opportunities for sub-Saharan African country with its very young and dynamic workforce that's entering into the global market, into the labor force, to integrate into the global market and be a source of strong growth for the region. Related to this, technology also allows our countries to leapfrog some industries, as we've seen, for example, in the case of the financial sector, with the adoption of mobile technology, allowing us to move to a new generation of financial service provision without going through the traditional banking sector and the like. So, technology does have this positive aspects in terms of, and it's not, this unfolding industrial revolution is not to be feared. And last but not least, with the advent of, services that are now more tradable than they used to be, and services becoming an important engine of growth, again, we see tremendous scope, subject to our countries upgrading human capital to participate in increasing tradability of services. So this fourth industrial revolution that is unfolding does offer opportunities for sub-Saharan Africa to integrate into the global economy. At the same time, however, there are risks that are involved. As I noted, the transitions in the past with the invention of new technology have been quite challenging and very disruptive. We're seeing some of this playing out in the advanced countries, and of course, we also countries also have to bear in mind that this disruption that technology can have, particularly, for example, with low-skill type jobs being done by robots, can be a source of hindrance in terms of sub-Saharan Africa's ability to move up the technology ladder. A second challenge that we see for the future of work in the region is that, unlike in the past, there is a possibility that technology may substitute labor rather than complementing labor. So we've seen some of this happening from the reshoring of activities back to some of the industrialized countries, and the work being done by robots rather than labor. So again, these kind of transitory effects can have some impact for the job creation challenge that the region faces. And last but not least, of course, has been the overall trend that we've seen globally of declining labor share of income. This has been a trend so far that we have not been able to establish in low-income countries, whether it's been also the practice because of scarcity of data. But again, if the experience of middle-income emerging market countries and advanced countries where the labor share has been declining also plays out in our countries, it can pose a significant challenge for countries in the region. Just to conclude, in terms of our, and summarize and conclude our findings, the key takeaways are, first, that there is a recovery and growth that we're seeing in the region, albeit in the context of rising risks, particularly related to financial sector, international financial developments. Second, fiscal deficits have narrowed, but the quality of fiscal adjustment in the region needs to be improved to be able to address debt vulnerabilities, and particularly focus it more on domestic revenue mobilization to be able to create space for development spending. And then, depending on country circumstances, there's a panoply of measures that are going to be really important to engender higher growth in the region. In some cases, this will revolve around improving policy frameworks. On the fiscal fronts, for example, we are seeing, in oil importing countries, it will be really, really important to make sure that generalized subsidies or fuel subsidies, which are highly regressive, do not emerge and the pass-through of higher oil prices higher oil prices need to be passed through with adequate protection, of course, for vulnerable groups through targeted interventions. Oil exporting countries, it will be very important to use this higher oil price environment to resume and rebuild buffers. We shouldn't forget how bad the last couple of years have been. Minister Udoma is tired of me saying this. On the monetary front, I really want to stress how important it will be to allow, in those countries where exchange rates are flexible, to allow exchange rates to move in response to some of the shocks that we've seen. In recent weeks, we've seen quite a lot of pressure on exchange rates, and the response of many countries has been to use reserves to intervene. However, the pressure on exchange rates really has to be seen as a dollar strengthening story rather than country-specific weakness. We've seen exchange rates in countries as robust and with good policy frameworks as like Australia, New Zealand, many emerging Asian countries, all movements in exchange rates that are between the 7 and 10% range just in recent weeks. So the story really is one of dollar strengthening, and if we resist the pressure by intervening, what we're doing is removing our buffers from already low levels, reducing reserve buffers from already low levels. So, policy frameworks that are adaptive, that respond to developments will be very important. Promoting economic diversification, of course, will be key, particularly for oil exporters. And building on initiatives in the region that, like the recently announced continent-wide free trade area, will be really important to facilitate new sources of growth for our countries. Let me stop there and hand over to Minister Udoma. Thank you.
Thank you, Abe. I will now invite Minister Udoma to deliver his remarks.
Okay. Thank you very much. Thank you for the opportunity to join today at the presentation of the IMF's Regional Economic Outlook for Sub-Saharan Africa. I must appreciate Abebe Selassie. His presentations are always very clear and lucid, and I thank him for that. I'm very happy to note that the IMF expects improved growth for Sub-Saharan Africa in 2018. Improved growth from 2.7% in 2017 to 3.1%. I know 3.1% is still not good enough with the rate of population growth. We need to grow at much faster than that. And I also agree with him that the per capita growth rate is not moving fast enough. I also appreciate that given the size of the Nigerian economy, developments in Nigeria have a significant effect on the overall performance of Sub-Saharan Africa. So I will speak a little bit about Nigeria. In Nigeria, our initial projections were that we would grow at more than 3% this year. And this was up from 0.8% in 2017. However, due to some oil production challenges in the second quarter, which are being resolved, and reduced agricultural output due to some local communal conflicts between herdsmen and farmers, as well as some flooding in the agricultural belt, we have had to reduce our projection for this year to 2.1%. But the good news is that we are taking action to resolve all those issues. We notice, of course, that the IMF projection for Nigeria is 1.9%, which is slightly lower than ours. However, given that Nigeria's growth in 2017 was 0.8%, even if Nigeria achieves only 1.9% this year, I think that will be a positive, very positive movement. So the direction of movement of Nigeria is positive and encouraging. We are actually hoping in 2019 to grow at up to 3%, and in subsequent years to grow even faster. It will be recalled, and I think that it's good to put things in some context, that following the collapse of crude oil prices from 2014, it culminated in our sliding into recession because we were dependent on that one commodity, and that is what we are working to try and diversify the economy. So we developed a medium-term plan, which we call the Economic Recovery and Growth Plan from 2017 to 2020. It was launched in early 2017, and it focuses on 5 strategic areas: macroeconomic stability, economic diversification and growth drivers, competitiveness, social inclusion and jobs, as well as governance and other enablers. Since we launched the plan, things have started getting better in Nigeria. We believe that the plan is working. We have been able to bring down inflation from 18.7% in January last year to 11.2% in August this year. Our aim is actually to bring down inflation to single digits, at least by either next year or by 2020 at the latest. The exchange rate market has been stabilized through the introduction of the investors and importers foreign exchange window. We have also been able to build up our external reserves from $27 billion in 2016 to about $44 billion by early this month. Our current account as a ratio of GDP has moved from a deficit of 3.2% of GDP in 2015 to a surplus of 2.8% by the end of last year, 2.8% of GDP. And this is built on export growth that is diversified, both oil and non-oil exports. We're growing on both, and we've managed to keep our imports stable. The ERGP, of course, deals with both oil and non-oil. I think it's important that we make sure that we get oil production back. At some point in 2016, because of militant activity in the Niger Delta, oil production was actually down to about 1 million barrels a day. And through positive engagement with the communities in the Niger Delta, we have improved the environment for oil production. And this was one of the policies of the Economic Recovery and Growth Plan, to engage in dialogue and to engage with the communities of the Niger Delta and assure them of fairness from the government. So we've improved the environment for oil production. And apart from technical hitches, which we have from time to time, we are now able to produce at up to 2 million barrels a day, so as to take advantage of the more favorable international oil prices. If indeed our target is 2.3 million barrels a day, and we believe that this is achievable, we're hoping to achieve this by the end of the year. And overall, the implementation of the various initiatives in the ERGP has resulted in, as I said, moving out of recession and going on a path of growth. Our growth at the last second quarter of 2018 was about 1.5%, but non-oil growth in the second quarter was actually 2.05%. So in fact, we are firing on all engines. And we remain confident that by the end of this year, we'll be able to grow at 2.1%. So with the implementation of the ERGP, we're better placed today to withstand the external shocks that Abebe Selassie spoke about. We are in a much better position now, and these actions have helped us to build buffers and appropriate measures to safeguard us from any external shocks. And notwithstanding the upcoming elections in February next year, we are continuing to focus on the delivery of our programs and policies. We've been directed by our President, Muhammadu Buhari, not to be distracted by the noise of the electioneering. And we also have an ERGP implementation team. The ERGP is the Economic Recovery and Growth Plan. We have an implementation team working hard to deliver on the plan's outcomes. As indicated by Abebe, one of the issues that in sub-Saharan Africa that we have to focus on is security. In Nigeria, indeed, tackling security was one of the three policy thrusts of the current administration. It is one of our three policy trusts. In this context, government has been able to degrade the capacity of the Boko Haram insurgents and bring stability to the affected region. We are implementing a humanitarian response plan to resettle the victims and return them safely back to their homes. Schools have reopened, farming and other activities are being restored. We're also strengthening the cooperation with our neighbors to deal with these security problems because some of them are trans-border issues. With respect to the problem of debt vulnerabilities, I agree with the IMF that it's an issue that requires constant monitoring. Even though we in Nigeria have one of the lowest debt levels, I think our debt to GDP is about 19%, so it's one of the lowest. But we realize that we need to improve our revenues to bring down our debt service to revenue ratios to more comfortable levels. So we're intensifying work in domestic revenue mobilization and maintaining fiscal discipline. We are broadening our tax base through policy reforms such as the tax amnesty program. This, amongst other measures, has resulted in the number of taxpayers rising from 13 million in 2015 to over 19 million today. And we're still growing, we're still identifying and getting more taxpayers into the net. We're deploying technology in tax and customs collections to automate processes and enhance efficiencies. We're also shifting our domestic debt portfolio to longer-term maturities. And our external debt is primarily concessional borrowing, representing 54% of our external debt as at June 2018. We have debt sustainability analysis we conduct annually to reaffirm that our public debt stock is sustainable. And in Nigeria, our borrowing has been directed principally to fix our infrastructure, to create a better enabling environment for private investment. I generally agree with the IMF that appropriate policies are needed to enhance the resilience of the region from all forms of vulnerabilities, to create more jobs for our rising youth population, and to raise per capita income. I certainly agree with that, with all those recommendations. From the report, the IMF projects that we need 20 million jobs annually over the next decade. In Nigeria, jobs has also been a key focus. And in the Economic Recovery and Growth Plan, we target to create about 15 million jobs by 2020. And we intend to achieve this principally through stimulating the private sector. Our aim is to make Nigeria a more investment-friendly place, a more attractive place for people to do business. One of the initiatives that we did, we conducted sector-specific labs that we refer to as the ERGP Focus Labs, in which we brought potential investors and government officials together to seek to remove the bottlenecks and impediments impeding investment projects. Through that process, we identified over $22 billion worth of potential investments, which could be unlocked if we can remove some of the impediments. So we intend to work with the private sector to remove these impediments. We also introduced, because we know that no matter how much the private sector grows, there'll always be some people left behind. So we introduced a social investment program with annual allocations of 500 billion naira, which is equivalent to about 1.6 billion US dollars in each of our budgets since 2016. We are committed to implementing policies and programs that promote social inclusion and deliver growth that is more diversified, inclusive, and sustainable. We are increasing investment in human capital. Just as an example, since 2015, we have quadrupled the federal government allocation to education and health. But of course, education and health in Nigeria, because we're a federation, we work with the states. I mean, the states actually are the primary, for primary health as well as education. Basic education is mainly the state. So we work very, very closely with the state. But we are doing our own at the federal level. And with regard to private investment flows, I do agree with the policy advice by the IMF that we need to put in place sound macroeconomic policy management to mitigate the risk associated with volatile capital flows. However, our experience in Nigeria is that even though we target foreign direct investment, that foreign direct investment doesn't come in unless they also see portfolio investors coming in. And so we want both. We believe that in order to get foreign direct investment, we also have to encourage portfolio investors, and we do encourage portfolio investors. And one of the ways that we have done to try and mitigate some of the risk is building up our foreign reserves, so that we can mitigate some of the risk of a sudden flight of capital. We also set up a presidential enabling business environment council to help with trying to get private investors. And finally, I agree with Abebe. I think that it was probably the most exciting part of the presentation when he was talking about effectively the fourth industrial revolution, where advancements in artificial intelligence, robotics, self-driving vehicles, nanotechnology may be actually disruptive of creating jobs. The way that we are aware of this risk and the way that we are tackling it in Nigeria is, as set out in the Economic Recovery and Growth Plan, is to invest in broadband and digital technology and to educate and train our people, particularly our young people who are very dynamic, very interested, easier for them to learn than for some of us, the new technologies. And so we're trying to focus a lot of effort on the young to educate and train them so that they're capable of understanding and responding to these new technologies. We must prepare our people, and that is important in sub-Saharan Africa. We must prepare our people for this brave new world. If possible, as Abebe said, we must find a way to leapfrog. An example where that is already taking place is mobile money, in which I think Kenya is at the lead in mobile money and in financial inclusion. And there are things that are being done in mobile money in Kenya that most Western countries are not able to offer. So it is important that we focus on that. So having said that, I must once again thank Abebe for a very useful presentation. I apologize that I focus on Nigeria. That is the country that I'm familiar with, and I thought that I should use the Nigerian example to illustrate the various issues which have been raised by the IMF. Thank you very much.
Thank you, Minister Udoma. Now we'll open it to questions. We have roughly half an hour for the discussion, so I'll invite you to keep your questions as short as possible. We have mics on the side of the room, so if you want to ask a question, please use the mic. Just behind you.
Thank you. My name is Sunday Michael, and I write for Daily Trust Nigeria. I have one question each for Mr. Abebe and Senator Udoma. And my first question goes to Senator Udoma. You talked about encouraging portfolio investors, and that would entail keeping the interest rate high. And at the same time, you talked about bringing inflation rate to single digit. I wonder how we'll be able to manage this with regards to encouraging the real sector if we continue to offer incentives to bring in foreign investors, foreign portfolio investors at the detriment of growing the real sector to create the kind of jobs that you talked about. So I would like you to throw a bit more light around that. To the IMF, every time there had been this emphasis right from the April meeting to always increase the tax base, and you are quick to always mention the need to double the value-added tax, especially in the sector. In sub-Saharan Africa, where we have seen small companies struggling with creating infrastructures for themselves to operate. And so my worry is, how do you encourage these companies to grow and create the needed job that they need to do if you continue to stifle them with more tax? I want to hear from you how you think that will work. Thank you.
Thank you. Abe, you want to take the second question?
Do you want me to do it first? So I think it's a very good question. I mean, why do we keep emphasizing taxes, and how is that consistent with promoting small and medium enterprise growth? Let me be very pointed about this. The investment needs in our region, in health, in education, in infrastructure, remain tremendous, and the demand for those to be addressed by people is really, really strong. And of course, we all see it daily and know it. The second is, of course, at the same time, we've seen mounting concerns about the level of debt, rising level of debt, and it's not just institutions like the IMF that are flagging this, but of course, civil society organizations, policymakers are concerned about it. So the question is how to square the circle. Our economies need more resources. Borrowing is not the option because debt levels are rising. So how do we address this challenge? Frankly, the only durable, sustainable way of being able to pay for the needs that we have is the tax base. Of course, it would be nice if we could get free money from somewhere, but there is scope to do more internally by mobilizing tax revenue, and that's the most sustainable way of being able to pay and address all of the needs that our countries have. Our estimates show that there is scope to do between 3 and 5 percentage points of GDP in tax revenue in most countries over the medium term. And what we do in a lot of our work is to flag, and identify ways this could be done. We recommend generally between 0.5 and 1 percentage points of GDP per year in tax increases, partly through administrative improvements, partly through policy measures. However, what the specific policy should be is going to be dependent on each country, on the politics within each country as to how to pay for this. And it's difficult for us to prescribe what the tax handle needs to be used in each country. In some cases, it could be property taxes. In other cases, it could be relying on more excises. In yet other cases, it could be increasing fees for services, or toll roads, and the like. So, what actual taxes are used is down to the political debates that have to be had in each country. But I think the overall direction has to be in terms of mobilizing more resources to find sustainable ways of financing the development needs our countries have.
Thank you. I think the question that was directed at me was that there is some sort of conflict between the attracting portfolio and domestic investment. The objective of Nigeria is domestic investment to create a climate, and it's clear in the ERGP, to create a climate where we stimulate in foreign direct investment, bring down interest rates. They bring down inflation. That is the focus. As far as portfolio investors, we are not hostile to portfolio investors. We ensure that we are reliable. You can come in with your money and you can take your money out. That is what we're not hostile to. But the policy framework is to bring down inflation and bring down interest rates. Thank you.
Thank you, Minister Odoma. Yes, in the second row.
My name is Obi Nachima. I work with This Day newspapers in Nigeria. I have two questions, one for Senator Odoma and one for Mr. Abebe. Senator Odoma, you said under the ERGP Focus Lab, we have some potential investors you're expecting. I want to find out, when specifically are we expecting these investors? Because we've been hearing about the potential investors for more than a year now. Is there a duration, is there a particular time we should be expecting them? And Mr. Abebe, in your earlier remark, you said there's every possibility that cost of borrowing will go up due to interest rate normalization in the US and other advanced economies. The Nigerian government will be seeking to tap on the Eurobond market in the next few months, possibly. Considering the high debt to GDP to debt service ratio, which is about 60% now, what advice will you be giving to the Nigerian government? Thank you.
Thank you. We'll take another question, maybe sir in the first row.
Thank you very much. My name's Helmer Preuss from Alliance News. I'm looking specifically at South Africa. You've downgraded the growth rate. We entered a technical recession in the first half of this year. Are you looking at growth increasing in the second half, or do you expect the recession to continue? And then in terms of the growth rate, then impacts in terms of the fiscal policy. And you've got the fiscal deficits remaining at the same time. The whole idea of the February increase in VAT rate was to improve the fiscal revenue, and the data that has been available is that revenue is exceeding and improving. So the fiscal deficit in nominal terms has been coming down, and certainly substantially also in terms of percent of GDP, which should improve your fiscal going forward, but you still got it increasing in the years ahead. If you can just explain what you're looking there. And then just the final technical question is, in terms of GDP growth, do you look at it from an expenditure point of view or a production point of view? Because in the first half of the year, on a year-on-year basis, if you look at it production, it was 0.6%. If you look at it from an expenditure point of view, it was 1.2. So your 0.8, is that an increase from the 0.6 of the first half, or a decrease from the first half to the second half?
Thank you. Do you want to take the question on South Africa first?
Okay. Sure. Yes. There was a question about the ERGP Focus Labs, which were held earlier this year. And you're asking, when do we expect the projects? Well, wearing my private sector hat, any major project, it would normally take at least 2 to 3 years from conception to development and so on. And we just did the labs this year. So I think you should be looking at within the next 2 years. But there is a team of 4 dedicated persons who were recruited, and they are all senior special assistants to the president. And they're actually working with the investors. There are some in agriculture, there's some in solid minerals, and in gold in particular. And so what they're doing is they send reports to me on almost on a weekly basis where there are issues that need to be taken up to His Excellency the Vice President. I do that. And then we have a committee of ministers that meets to review each of the projects to see where they are and what they require. But to answer your question, I think it will take at least 1 or 2 years before they actually come to fruition. Thank you.
On the first question was about optimal way for Nigeria to do its borrowing. As the minister noted, in the specific case of Nigeria, the concern is not about the level of debt itself, which remains fairly manageable, below 20% of GDP. So, however, what is the pressure point is the very low level of non-tax revenues, in particular in Nigeria, as a ratio of interest payments relative to the level of non-tax revenue is very, very high. So the focus on fiscal policy side has to be on raising non-tax revenues to not just be able to pay interest rate, but more importantly to create space and room for addressing the many development objectives that the government has. Our advice in the past for Nigeria has been to enhance the mix of instruments that are used to finance debt. So there is, in the past we've argued that there was some case for tapping external markets to diversify the sources of financing. I don't know at what juncture you're at right now, but of course, as always, bond issuances, tapping markets, always has to pay heed to the general market environment, the cost that you're being offered, and balance that against domestic borrowing. So those are all things that are going to have to be considered, and I'm sure will be considered by the government in Nigeria. On South Africa growth projections, we've been surprised by the volatility in the growth path in South Africa, and the revisions which have made the job of doing the projections difficult for policymakers, of course, first and foremost, and for us that try and follow this quite closely also. Generally, given the availability of quarterly data on both expenditure side and production side, we've in the past tended to use, we've tended to rely more on the expenditure side historically, but in recent forecasts, we've tried to use both to try and get a better feel. I cannot tell you quite frankly what the basis is going forward for our forecasts, but as always, what we try and do in our projections is to try and take into account all our understanding of what the current policies are, and this is true also for the fiscal deficit, what current policies are, and then of course update those for the latest observations we have for commodity prices, the path for the latest exchange rate observation, interest rates paths, and those can impact the forecast and lead to different numbers relative to our last Article 4, for example, relative to the numbers that we had in April. So these kind of adjustments often tend to explain the deviation.
Thank you, Abe. There's a question.
I just wanted to add, because on the issue of the revenues, I think we're talking about that there's a need for Nigeria to increase our revenues. I just want to say that the FIRS, the Inland Revenue, the numbers show that oil and non-oil, we are right now on a pro rata basis about 30%. In 2018, we have a 30% growth from the 2017 numbers. So we're gradually building up our revenues as well. Thank you.
Thank you. I'll welcome a question on other parts of the region. The minister here.
It's on.
It's on. Okay, sorry. Maybe I agree with you that the level of debt is not really a challenge. But then you say domestic resource, domestic revenue mobilization. The level of debt is not a challenge. The central challenge is the ability of the private sector to grow so that revenue are generated from that growth to service the debt. To me, as a minister, we're doing well we're trying to push on domestic resource mobilization, so I'm not speaking against that. But what I see the fund doing is to say, and the journalist was definitely right, is to say, okay, in a country with very low tax effort, we focus on DRM, even if the private sector is not going, we see this is the solution. In a country like Malawi, with a very high tax effort, what argument will you then make? Because they've done a lot to collect taxes. So in other words, I think the big solution is that these countries that borrow will have to grow the economies so that the private sector ultimately can grow. There's a wider gap between a country's economy and its growth potential than the taxes collecting today and its tax potential. I would see the fund doing a little bit more on both sides in terms of, why is it after all this debt in Africa, yet the private sector is not taking up to unpack the bundle of that debt? Can you share some comment on that? DRM is fine, but to me it's a quasi-false solution because you're just saying increase your effort to collect. When you get to your best tax, okay, then stay there until let's see what happens.
So, the way I would look at it is, I think both need to go hand in hand, meaning both the effort to collect more revenues, plus, of course, important job of promoting private sector growth. One of the challenges of trying to paint this picture on the region is the extreme heterogeneity, the really strong divergence in the circumstances across countries, the heterogeneity across the region. So it's difficult to generalize what the tax points are. But you're very right that, so Malawi is one of the countries, despite its low level of income, which has a very strong tax effect. Tax to GDP ratio is of the order of 18% or so. Does that mean that Malawi no longer has any more room to mobilize more resources? They probably are at, close to the limit. That's why when I posited the kind of objective the countries can have, I said a range of between 0.5 and 1 percentage points of GDP. Certainly Nigeria should be more on the, 1 percentage point of GDP additional revenue mobilization for sure, if not more. So we do see a range of, in terms of what the revenue mobilization potential is for countries. But, Malawi, even at 18%, continues to have tremendous investment needs. So pushing the envelope there is really important. Before I transition to facilitating private sector growth, the other point I want to really stress is that one thing that has us worried about the debt service ratio continuing to rise is that what it suggests to me is a lot of the reason why debt has gone up has been investment in infrastructure by countries. So we've seen really good infrastructure being built in the region over the last several years in roads infrastructure, in electricity infrastructure, and the like. But when you see the debt service ratio continuing to go up, what that suggests is that the investment, the rate of return on this investment has not been captured by the tax system. Okay, so not enough is being done to capture the benefits of the, additional electricity we're providing. So we do see a gap there in terms of capturing the rate of return on the investment that has been made. So that's also where the potential comes from. So that's on the tax revenue side. And then on promoting private sector investment, of course, the policies that are required are very country specific. In some cases, the business environment is not conducive to private sector growth. The licensing requirements, the regulatory requirements, the barriers to entry that we have. In other cases, it's more subtle. The challenge is more subtle. You have countries with very, very strong business environments, and you're still not seeing private sector investment picking up. So in those kind of cases, it may be that you need to address financing constraints that the private sector is facing. So I think in some, I don't quite see too much of a tension between policies to address revenue mobilization and the reforms that you need to foster stronger private sector growth.
Thank you, Abe. We have less than 5 minutes to go, so I will call on the first row here.
Thank you so much. A very nice presentation. On the future of work, I'm not quite clear why we're too much worried about disruptive technology in Africa now. My thinking was that we have yet to exploit actually the potential for using ICT to make growth inclusive. Look at countries like Kenya, Zimbabwe. I mean, the focus should be on how ICT can actually enhance growth and also make it more inclusive. And I see the AI of the world, the internet of the world, but is it an immediate fear? I mean, and if you look at different countries, which countries should be more concerned about this?
Thank you. We'll take a question here, the gentleman in the white.
Your Excellencies. Yes, Your Excellencies, I want to thank you very much. It was a very good presentation I've heard about, and it's a beautiful comparison between Nigeria and South Africa I was seeing in this book, which was very interesting. I want to tell you, I'm from India, from the Hinduja group of companies. We have been working in Nigeria, and we did a project with private-public partnership in 2009 and 2010, completed a BRT project with private-public partnership. Now, after the project was completed, the case study was done by the World Bank. And we tried to replicate this project in other counties of Nigeria, in places where they had a problem of traffic, the problem of congestion. And I've been talking with different finance ministers, and we said we want to bring in foreign investments from India. We want to bring in partnership from the World Bank, from the IFC and everybody, but nothing was happening. Nothing moved. So now I would like to inform you that India had a conference. They had a meeting in Abuja. Our commerce minister went there, and we want to invest in Nigeria. We want to bring new strategies, new programs, new business investments over there. But we will need the help of IMF, because IMF is the only today a solution who can really help the countries who are in a debt problem. I'll tell you for Ghana, for example. We have got a business in Ghana. They cannot open letter of credits because they are having a debt problem. So they gave me a solution. Said as the CKD, assemble the vehicles in Ghana, and we will open and the local African banks will pay you the money later on. So the solutions have to be given by IMF. What way the problems of each African countries can be solved. So I will request very much IMF to play a very important role in the program countries who want to invest in Nigeria. There are so many. Saudi Arabia will come. I mean to say Abu Dhabi will come.
So we are running out
India
of time.
Will come.
Could you
so I'm requesting that find a solution for us and we will come in. Thank you.
Thank you. Abe.
Yeah. So should Africa really be so concerned about the unfolding industrial revolution at this time? I don't think we can ignore it. The scale of the jobs challenge that have to be, the new jobs that have to be created is so large and increasing each year for the next 10, 15 years, peaking at around 20 million jobs that need to be created by 2030 or so, that we have to think about the kind of jobs that will be created going forward, whether we'll still be able to use low-skill manufacturing as an option for labor-intensive growth. We have to, it behooves us to think about, what impact the ongoing technological change could have on the type of jobs that are being created. And frankly, there is a lot of uncertainty on this. So there are some studies that show that the threat really is more to advanced countries, jobs that are being done in advanced countries from the technological revolution. But there are other studies that show the threat actually is on low-skilled manufacturing type jobs from robots, so less artificial intelligence, but more, the automation of simple procedures. So it behooves us to think about this and what kind of challenges that it might pose. It's an area where there's a lot of uncertainty, as I said, but so the question really has been, and what our work shows is what kind of basic things we're going to have to do to prepare our workforce for the jobs of the future. And our recommendations are that it's important for us to think about how we can upgrade education systems. As I noted, there is already an existing challenge of needing to do better on secondary school education outcomes, for example. In some cases, it's still primary school education. But upgrading the quality of education in our countries will be important. It will also be important, I think, to bring into the discussion the need to think about facilitating more investment, maybe not by the government itself, but certainly by the private sector, creating possibilities for, and including in the normal, in the same way we talk about road, rail, ports as infrastructure, we probably have to think about, 5G networks, etc., being as part of the core infrastructure that we have to eye in terms of promoting. So, thinking about these kind of areas will be important to be able to make sure that we benefit from the coming the unfolding industrial revolution. So it's more from that angle that we did this work. Do you want to?
Yes, unfortunately, he just stepped out. Everything he said was music to my ears, and he just stepped out. He said he wants to invest in Nigeria. Excited about that. So I think we will engage with him. I suspect maybe he went out with the Nigerian ambassador. I think he may have gone out with him, but we will sit down with him. And if there's anybody else here who wants to invest in Nigeria, we can begin the conversation today. And I can line up all the people that you need to talk to explain the requirements, what you need to facilitate whatever you require. We've made visas very easy. You can get visa on arrival as well. We've made things extremely friendly and receptive. So if there are people who wish to invest in Nigeria, it's a place where there are a lot of opportunities. You have the workforce, they're educated people. So please, follow the example of the gentleman who indicated that he wants to invest in Nigeria. Thank you very much.
Thank you, Minister. We'll end on that positive note. So I'd like to invite you to give a round of applause to our panelists. Thank you.
Thank you so much.
Ladies and gentlemen, please remain seated while the delegation departs the auditorium.